All right, here we've got a session on special order decisions. And a special order is when, let's say, Walmart comes to you and says, I want you to produce 10,000 jars of grape jelly for me. All right, to get Walmart as a customer would be terrific, and it's a huge order, so you might be willing to give him a break on the price. Okay, another example right now would be respirators. Okay, hospitals need thousands of them, so they will for sure get a price break from like normal business. So when you've got special order decisions, you've got three questions that you've got to ask. First of all, do we have enough capacity? Okay, what are the incremental costs? How much is it going to cost us to fill the order? And then finally, will it affect our other sales in the long run? Okay, so for capacity, we'll look at capacity, the cost of capacity a little bit later, but you've got to make sure that you get excess capacity to fill the order, otherwise you might lose some of your regular customers. Okay, and then will the sales price cover the incremental costs of filling the order? And this is the key question. Okay, this is what you're going to spend most of your time on here. We only need to focus on the relevant information, though, the costs that will change if we accept the order. Okay, and generally these will be the variable cost, but sometimes the company might want like an item or a sticker or something added to a product. Sometimes there won't be any salesman's commissions too on these sales. Okay, so these are regular things that you want to check for in each problem. And about whether or not sales are affected in the long run, this is a strategic question. Okay, so if an order is going to affect your regular sales, then you need to decide which market you're in. Okay, so for all the remaining types of short-term decision-making problems in this chapter, okay, you want to pay special attention to a format to use to solve the problems. There are a lot of little pieces in these problems, but they're classic. Okay, you'll see the same things repeated over and over again, so you want a good standard approach. So the issues are always the same. So we're going to look at the Garnier example in the book. And then we'll look at the format that I use to do it and the analysis. And the last thing in here are the pitfalls. So you're going to accept it if the revenue exceeds the incremental costs. Okay, that took a lot of thinking. Okay, there's an example that we'll go through and then the pitfalls. So here are the assumptions from Exhibit 8.6. Garnier has the selling price for their shampoo was $3.20. This is per unit. Variable manufacturing costs $1.20, variable operating costs 30 cents, and the operating costs they told us were freight out and commission. So the contribution margin, $3.20 minus $1.50, is $1.70. Okay, now our fixed costs are $2 million of fixed manufacturing overhead and $1,250,000 of fixed operating expenses. Note that we look at these numbers in total. Don't break these down into per unit costs, okay? It'll get you all goofed up. So our buyer wants a special price. Instead of $3.20, they want, for the special order, they want to buy it for $1.60 a bottle. Okay, so that would be our price times how many I can't remember how many bottles, but it gives us $32,000. I'll have to go look it up. Okay, their manufacturing cost is going to be reduced by 15 cents because they're reducing the size of the bottle. Okay, so that's a savings of $1.05 from variable costs. No. Our variable costs are $1.05. I'll put brackets over here. There we go. And we have no commission or freight out, so there's no variable operating costs. I'll put that there too. Now I'm not aligned, but I guess I'm just going to have to live with it. Okay, so the contribution margin, $1.60 minus $1.05 in variable costs, is 60 cents per unit, or $11,000 in total. Okay. Now, fixed costs generally don't change, but they've got an additional fixed cost. They've got a legal fee to pay of $2,000, so we take that out in total. Okay, our incremental revenue then is $11,000 minus $2,000, or $9,000. All right, so we've made money on this. The only thing we've got to think about then is strategy on whether or not we're going to goof up our other sales. And finally, I've got a note here that it sounds dumb, but be careful about incremental revenue versus incremental cost. It's real easy to go the wrong way with one of these numbers, so go slowly and pay attention when you're doing it. okay? And then the managers have to decide if the regular sales will be affected. They'll look at the strategy issues. Now, the biggest pitfall with these is to base decisions on unit product costs. If you worked as a cost analyst in manufacturing and a manager asks you for a number or a cost, before responding, you'd ask, what do you want it for? Okay, because there are a lot of different costs. And once you put a fully absorbed unit product cost into a manager's head, it's going to stick there. So you need to remember that these costs include fixed overhead, and fixed costs don't increase with increases in production within the relevant range. All right, so you really need to use a contribution approach for decision making. Okay, all righty.